Imagine stepping onto Wall Street, surrounded by towering skyscrapers and the endless hum of traders chasing their fortunes. Every stock, every trade, every investment decision seems calculated, precise. Yet beneath this carefully orchestrated chaos lies a profound truth. The market is unpredictable, often irrational, and driven by forces beyond any single investor's control. In a random walk down Wall Street, Burton Malkiel dismantles the myths of stock-picking genius and market timing, revealing a world where chance plays a far greater role than most investors dare to admit. With compelling historical examples, rigorous analysis, and an accessible writing style, Malkiel guides us through the triumphs and failures of financial speculation, offering a simple yet revolutionary conclusion. The best path to wealth isn't found in chasing trends, but in embracing a disciplined, long-term strategy. This book isn't just about investing, it's about reshaping the way we think about money, risk, and financial freedom. Chapter 1. Firm Foundations and Castles in the Air. Investors have always searched for ways to determine the true value of assets. One approach believes that every stock has an intrinsic value, which is based on its financial health and future growth potential. This idea suggests that if someone can accurately estimate a company's worth, they can buy stocks that are undervalued and sell those that are overpriced. The logic is simple. Markets might fluctuate, but in the long run, a stock's price will align with its real value. This thinking has led many investors to study earnings reports, analyze balance sheets, and project future profits, believing that they can predict how a stock will perform over time. Another way of looking at the market suggests that prices don't always follow logic. Instead, they're driven by investor emotions, expectations, and popular trends. In this view, stock prices can move far beyond their actual worth simply because people believe they will keep rising. Investors see others making money, and they rush to buy before the price goes even higher. As more people join in, the stock's value rises, not because of solid business fundamentals, but because of collective excitement. Eventually, when people realize the price is too high, the enthusiasm fades and the stock crashes. This pattern has repeated itself many times in history, creating financial bubbles that eventually burst. One example of irrational market behavior occurred during the Dutch tulip mania. In the 17th century, tulips became so popular that their prices skyrocketed. People believed they could buy tulip bulbs and sell them at a higher price later. As more and more buyers entered the market, prices soared to ridiculous levels. Some tulip bulbs became worth as much as houses. But in the end, when people stopped believing the prices would continue rising, the market collapsed. Tulip bulbs, once seen as treasures, became almost worthless overnight. This same pattern has appeared in stock markets. At times, a new industry or a new company excites investors so much that they push stock prices far beyond any reasonable valuation. The rise of railroads in the 19th century led to wild speculation, with people pouring money into companies that had little chance of success. In the 20th century, new industries like radio, automobiles, and airlines triggered similar investment frenzies. Each time, early investors made huge profits, attracting more people into the market. But when reality set in, most of these stocks crashed, leaving late investors with heavy losses. The lesson is clear. While it is tempting to chase the latest investment trend, history shows that such excitement rarely lasts. Many investors have lost fortunes by buying stocks at inflated prices, thinking they would always go up. Understanding this pattern helps avoid costly mistakes. The challenge is distinguishing between investments with real long-term value and those driven by hype. Some companies do grow into their high valuations, but many others fade away when excitement cools. To navigate the stock market successfully, it is important to recognize the difference between investments based on solid financial reasoning and those driven by speculation. While some believe that careful analysis can lead to reliable predictions, others argue that trying to beat the market is a risky game. Stock prices reflect not just facts, but also human emotions and unpredictable trends. By understanding both perspectives, investors can make smarter choices. Rather than getting caught up in market frenzies, it is wiser to approach investing with patience and discipline. While quick profits might seem appealing, sustainable wealth comes from steady, well-reasoned decisions. The history of financial markets has shown that speculation can lead to massive gains, but it can also result in devastating losses. Recognizing this reality is crucial for anyone looking to build lasting financial success. Chapter 2: The Madness of Crowds. Throughout history, people have often made the mistake of believing that prices of certain assets would keep rising forever. This belief has led to financial bubbles where people rush to invest, only for the market to collapse, leaving many in financial ruin. One such event occurred in the 1600s in the Netherlands, where tulip bulbs became more valuable than houses. People were so eager to invest in tulips that they paid enormous amounts for them, believing they could sell them for even higher prices. But suddenly, the prices collapsed, and those who had bought bulbs at high prices were left with worthless flowers. This was one of the first recorded financial bubbles, proving that when people blindly follow the crowd, they often get trapped in disasters. A similar event happened in the early 1700s in England. A company called the South Sea Company promised to bring huge profits through trade with South America. Investors, driven by greed and excitement, poured money into the company, expecting their wealth to grow. The company's stock price kept rising as more and more people bought in, thinking it was a guaranteed way to get rich. However, there was no real business behind the hype. When the truth became clear, the stock price crashed, and countless people lost everything. The same pattern repeated in France around the same time. A man convinced the public that he could make France rich by setting up trade in the Americas. The people believed him, and his company's stock price soared. As before, it was built on empty promises. Eventually, when people realized that the company's earnings did not match expectations, panic spread, and the market collapsed. The pattern of financial bubbles did not stop with tulips or trade companies. In the 1920s, a new wave of excitement surrounded the stock market. People believed that modern businesses would keep growing, and they borrowed money to buy stocks. This created an illusion of endless wealth. Prices skyrocketed because everyone wanted to invest, but the reality was different. Many companies were not earning enough to justify their high stock prices. When confidence broke, panic selling began. In 1929, the stock market crashed, leading to the Great Depression, one of the worst economic crises in history. History repeated itself again in the late 20th century with the dot-com bubble. As the internet became popular, new technology companies emerged, promising to change the world. Investors were convinced that any company related to the internet would be successful. Stock prices of technology firms soared, even when these companies had no real profits. Some were not even generating revenue. But people ignored reality and continued buying stocks because everyone else was doing it. When it became clear that many of these companies would never make money, their stocks collapsed, wiping out billions of dollars in wealth. A major lesson from these events is that financial bubbles happen when people ignore facts and follow excitement. When prices rise too fast and people invest based on hype rather than reality, disaster is often near. It also shows that no matter how confident people feel about an investment, if the prices are rising only because others are buying, the situation is dangerous. Another important lesson is that the belief in endless profits is always an illusion. In each case, people thought prices would never fall, but history proved them wrong. Those who sold early made fortunes, while those who waited lost everything. It also becomes clear that financial bubbles are fueled by human nature. People love to believe that they have found an easy way to get rich. They trust that the crowd must be right because so many people are making money. But this thinking has led to some of the worst financial collapses in history. Those who stay cautious and look at real value rather than popular excitement avoid these traps. Instead of chasing the latest trend, the safer approach is to invest in things with real, lasting value. This has been proven repeatedly throughout history. Chapter 3. Speculative Bubbles from the 60s through the 90s. Between the 1960s and the 1990s, financial markets saw multiple speculative bubbles, each demonstrating how excitement and overconfidence can drive stock prices far beyond their reasonable value before reality ultimately brings them crashing down. These bubbles highlight the risks of excessive speculation and the difficulty of consistently predicting market movements. In the 1960s, the Nifty 50 stocks dominated Wall Street. These were 50 large, well-established companies such as IBM, Xerox, and Coca-Cola, considered so strong that their stocks were believed to be perfect long-term investments. Investors thought these companies were immune to economic downturns and that their prices would always rise. Because of this belief, they were willing to pay extremely high prices for these stocks, even when the earnings of these companies did not justify such valuations. The optimism surrounding these stocks created an illusion that they could be bought at any price without risk. However, no company, no matter how strong, can maintain endless growth. As inflation rose and economic conditions shifted in the 1970s, many of these stocks saw their prices collapse. Investors who had ignored the risks and followed the crowd lost large sums of money when the bubble burst. In the late 1990s, the dot-com bubble became one of the most famous examples of speculative mania. The rise of the internet led to widespread excitement about technology and e-commerce, encouraging investors to pour money into any company that had .com in its name. Many of these businesses had no profits and, in some cases, no clear business models, yet their stock prices skyrocketed simply because investors believed that the internet would revolutionize the economy. Traditional valuation methods were ignored, and people invested based on speculation rather than solid financial fundamentals. Companies such as Pets.com and Webvan became symbols of this craze, attracting massive investments despite their lack of profitability. As long as stock prices kept rising, few people questioned whether these companies could actually succeed in the long run. Eventually, reality set in. Many .com companies could not generate the revenues needed to sustain their high stock prices. As investors began to realize that these businesses were not as profitable as they had hoped, panic selling started. Stock prices, which had once soared to extraordinary levels, plummeted rapidly. Many companies that had been valued in the billions disappeared overnight, wiping out the savings of those who had invested without considering the risks. The crash of the dot-com bubble reinforced the lesson that enthusiasm alone does not make a company successful. Strong financials and sustainable business models are necessary for long-term success. Each of these speculative bubbles shared common patterns. Investors became overly optimistic, assuming that prices would keep rising indefinitely. Traditional methods of evaluating investments were ignored, and people bought stocks simply because they saw others doing the same. Greed and fear of missing out replaced rational decision-making. When prices eventually reached levels that could no longer be justified, panic set in, and the bubbles burst, leaving many investors with significant losses. These episodes highlight the importance of disciplined investing. History shows that even the most promising trends can become overhyped, leading to unsustainable stock prices. It is crucial to focus on long-term value rather than chasing short-term gains. Instead of following market fads, investors should evaluate stocks based on solid financial principles, considering earnings, cash flow, and business fundamentals. Speculative bubbles will always exist, but those who remain cautious and avoid getting caught up in irrational excitement are far more likely to achieve lasting financial success. Chapter 4. The Firm Foundation Theory, the Discounting Machine. The Firm Foundation Theory is built on the idea that every asset, including stocks, has an intrinsic value that can be determined by analyzing its present earnings and future potential. This intrinsic value is not based on market speculation or investor sentiment, but on the fundamental financial health of a company. The key principle behind this approach is the process of discounting future cash flows, which helps investors estimate the present worth of a stock based on its expected future earnings and dividends. To apply this method, an investor begins by examining a company's financial reports. These reports provide critical data, including revenue, expenses, profit margins, and overall business performance. One of the most important aspects of this analysis is the company's earnings, as future earnings growth is a major driver of stock prices. Companies that demonstrate consistent profit growth are often considered more valuable because they are likely to generate higher dividends and reinvest profits into further expansion. Once the expected earnings and dividends are determined, the next step is to discount them back to their present value. Discounting is necessary because money received in the future is worth less than money received today due to factors such as inflation and opportunity cost. The discount rate used in these calculations is influenced by interest rates and the perceived risk of the investment. If interest rates are high or the company is considered risky, the discount rate will be higher, reducing the present value of future earnings. While this theory provides a structured way to assess stock prices, it is not without its limitations. Predicting future earnings is inherently difficult, as businesses operate in dynamic environments influenced by competition, regulation, economic trends, and consumer demand. Any errors in estimating growth rates or selecting an appropriate discount rate can lead to incorrect valuations. Moreover, external factors such as government policies, global events, and technological disruptions can significantly impact a company's financial performance, making precise predictions challenging. Despite these challenges, the firm foundation theory encourages investors to adopt a disciplined and research-driven approach to investing. Instead of reacting to short-term market fluctuations or following speculative trends, investors who follow this method focus on analyzing financial fundamentals. This helps them make informed decisions about which stocks to buy, hold, or sell based on logical and data-backed assessments rather than emotional responses or market hype. Historically, many successful investors have relied on fundamental analysis, which aligns closely with the firm foundation theory, to build wealth over the long term. Companies with strong financial health, steady earnings growth, and a competitive market position tend to perform well over time, rewarding patient investors with consistent returns. However, the theory also cautions against overpaying for stocks, emphasizing that even a great company may be a poor investment if its stock price is inflated beyond its intrinsic value. In practical application, this approach can be used by both individual investors and financial professionals. Many institutional investors, such as pension funds and mutual funds, base their investment strategies on fundamental analysis, ensuring that they allocate capital to companies with strong long-term potential. For everyday investors, understanding and applying these principles can provide a solid foundation for making rational investment choices, avoiding speculative bubbles, and achieving sustainable financial growth. By focusing on the real economic value of an asset rather than market speculation, this approach provides a reliable method for identifying sound investments. It reinforces the idea that stock prices should ultimately reflect the true earning power of a business. While market prices may fluctuate due to short-term trends, the underlying value of a company is what ultimately drives long-term returns. Chapter 5: The Best-Laid Schemes. The Failure of Portfolio Management. Many people trust professional portfolio managers to make the best investment decisions on their behalf, believing that these experts have the skills and knowledge to consistently beat the market. These managers use advanced research techniques, analyze financial data, and apply complex investment strategies to identify profitable stocks. However, in reality, most of them fail to outperform the market over long periods. Despite their expertise, many actively managed funds struggle to deliver better returns than simple index funds that passively track the overall market. One major reason for this failure is the high cost of active management. Investors who put their money in actively managed funds must pay management fees, which are charged regardless of the fund's performance. These fees, though seemingly small, add up over time and reduce the overall returns for investors. In addition to these fees, active managers frequently buy and sell stocks in an attempt to maximize gains. Each trade comes with transaction costs, such as brokerage fees and taxes, which further eat into the returns. When compared to passive investing strategies, where costs are much lower, actively managed funds often end up delivering inferior returns simply due to these expenses. Another challenge for portfolio managers is the difficulty of consistently picking winning stocks. Financial markets are highly unpredictable, and even the most experienced managers cannot always foresee changes in stock prices. A company may look promising based on its past performance and growth potential, but unforeseen events like economic downturns, regulatory changes, or shifts in consumer behavior can drastically impact its stock value. Even if a portfolio manager correctly identifies a strong stock, timing the purchase and sale at the perfect moment is incredibly difficult. If a stock is bought too late or sold too early, the potential gains can be lost. Many people assume that portfolio managers have access to exclusive information that gives them an edge over regular investors. However, the efficient market hypothesis suggests that stock prices already reflect all publicly available information. This means that any new information is quickly absorbed by the market, making it nearly impossible for anyone to consistently find undervalued or overvalued stocks. If this theory holds true, then trying to beat the market through stock selection and market timing is largely a matter of luck rather than skill. Because of these factors, a growing number of investors are shifting towards passive investment strategies. Rather than trying to beat the market, passive investors accept the market's overall performance by investing in index funds. These funds are designed to replicate the performance of major stock market indices, such as the S&P 500. Since index funds do not require frequent trading and have minimal management fees, they offer a cost-effective way to invest. Over the long run, index funds have been shown to outperform the majority of actively managed funds due to their lower costs and more stable approach. There is also the issue of survivorship bias, which makes active investing seem more successful than it actually is. Many poorly performing funds are quietly shut down, while only the more successful ones remain in existence. When investors look at past performance data, they often see only the funds that have survived, giving the illusion that active management is more effective than it truly is. In reality, for every fund that outperforms the market, many others have failed and disappeared, leaving behind only a selective history of success. While some portfolio managers may achieve exceptional results in certain years, very few can maintain this performance consistently over time. Many investors chase after top-performing funds based on past success, only to find that those funds struggle in the following years. Historical data shows that very few funds that outperform the market in one period can repeat that success in the next. Given all these factors, investors who aim for long-term financial growth should focus on minimizing costs and following a disciplined investment strategy. Rather than trying to outguess the market, they can achieve better results by investing in low-cost index funds and holding them for extended periods. This approach ensures that they benefit from the market's natural growth over time without being dragged down by unnecessary fees and risky stock-picking attempts. Chapter 6: Technical and Fundamental Analysis. Investors have long debated the best way to predict stock prices and maximize returns. Two of the most widely discussed approaches are technical analysis and fundamental analysis. These methods offer different perspectives on how to assess stocks and make informed decisions about buying and selling. While both have their proponents, they also come with limitations that investors must understand. Technical analysis is based on the idea that stock prices move in patterns that can be identified and used to predict future movements. It relies on historical price data, trading volumes, and market trends to identify opportunities. Supporters of this method believe that price movements are not random and that market behavior tends to repeat itself. By studying past price charts and using indicators like moving averages, relative strength index, RSI, and candlestick patterns, technical analysts attempt to forecast whether a stock will go up or down. However, there are major issues with this approach. One of the biggest problems is that patterns seen in charts are often subjective. Two analysts can look at the same data and come to completely different conclusions about where the stock is heading. Another issue is that past trends do not always predict future performance, especially when unexpected news, economic shifts, or sudden company changes disrupt the market. Furthermore, because so many traders use the same indicators, it can sometimes create self-fulfilling prophecies. When enough people believe a stock will rise because of a certain pattern, they buy it, which actually causes the price to go up. In contrast, fundamental analysis takes a completely different approach. Instead of looking at price trends, it examines a company's financial health to determine its real or intrinsic value. This involves analyzing financial statements, such as income reports, balance sheets, and cash flow statements, to understand a company's earnings, assets, and liabilities. Fundamental analysts also consider external factors like industry trends, competition, and overall economic conditions. The goal is to find stocks that are undervalued, meaning their current market price is lower than their true worth, so that investors can buy them before the market corrects itself. While this method is more grounded in actual business performance, it is not foolproof. Predicting a company's future performance is incredibly difficult, as many factors can change unexpectedly. A company that appears strong on paper might suffer due to management mistakes, new competitors, or regulatory changes. Even when a stock is identified as undervalued, there is no guarantee that the market will recognize it soon. Investors may have to wait years before their investment pays off, making patience a crucial factor in fundamental analysis. Some investors attempt to combine both approaches, using fundamental analysis to find promising stocks and technical analysis to determine the best time to buy or sell. Others avoid both and opt for passive investing strategies. One of the most effective long-term strategies is investing in index funds, which track a broad market index rather than trying to pick individual stocks. This method assumes that markets are generally efficient and that trying to beat them consistently through stock picking or market timing is extremely difficult. In the end, neither technical nor fundamental analysis can guarantee success. The stock market is influenced by countless unpredictable factors, making it nearly impossible to always make accurate predictions. While technical analysis provides useful insights into market psychology and trading behaviors, it is unreliable for long-term investment decisions. Fundamental analysis, though more data-driven, still requires investors to make assumptions about the future. Given these challenges, the best strategy often involves diversification, patience, and a clear understanding of personal financial goals. Chapter 7. Modern Portfolio Theory. Modern Portfolio Theory, MPT, introduced a new way of thinking about investments by emphasizing the relationship between risk and return. The idea is that an investor should not just focus on picking individual stocks or assets, but should consider how those assets work together in a portfolio. By holding a well-balanced mix of investments, it is possible to achieve higher returns while taking on less risk than investing in a single stock or asset class. At the core of this approach is the idea that different assets do not always move in the same direction at the same time. Some assets may rise in value when others fall, and vice versa. This is known as correlation. If two assets have a high positive correlation, they tend to move in the same direction. If they have a negative correlation, one tends to go up when the other goes down. By selecting assets with low or negative correlations, investors can smooth out the ups and downs of their portfolio, reducing the overall risk. One of the most important concepts in MPT is the efficient frontier. This is a graphical representation of the best possible portfolios that offer the highest return for a given level of risk. Every portfolio has some degree of risk, but not all portfolios are created equal. Some portfolios provide higher returns without increasing risk, while others expose investors to unnecessary risk without enough return to justify it. The efficient frontier helps investors identify the optimal combination of assets that provides the maximum return for the amount of risk they are willing to take. Risk, in this context, is measured using standard deviation, which indicates how much an investment's returns fluctuate over time. A high standard deviation means that the investment is volatile, meaning it can experience sharp increases or decreases in value. A lower standard deviation indicates more stable performance. MPT shows that by combining investments with different levels of volatility and correlation, investors can achieve a lower overall standard deviation for their portfolio than any individual asset within it. There are two main types of risk: systematic risk and unsystematic risk. Systematic risk, also known as market risk, affects all investments in some way. Examples include economic downturns, inflation, interest rate changes, and political instability. Since this type of risk impacts the entire market, it cannot be eliminated through diversification. However, unsystematic risk, which is specific to a particular company or industry, can be reduced by spreading investments across multiple sectors and asset classes. The more diversified a portfolio, the less impact the failure of any single investment will have on the overall performance. MPT assumes that investors act rationally and markets are efficient, meaning that all available information is already reflected in asset prices. This means that trying to beat the market by timing investments or picking individual stocks is unlikely to be successful over the long term. Instead, MPT suggests that the best approach is to build a diversified portfolio that aligns with the investor's financial goals and risk tolerance. Despite its strengths, MPT is not perfect. One of its limitations is that it relies on historical data to predict future performance. However, past returns and correlations do not always hold true in the future, especially during market crises when assets that usually move independently may suddenly become correlated. Additionally, MPT does not take into account transaction costs, taxes, or real-world limitations that investors face. For investors applying MPT, the best strategy is to create a diversified portfolio that spreads investments across various asset classes such as stocks, bonds, real estate, and commodities. Regularly reviewing and adjusting the portfolio can help ensure that it remains aligned with financial goals and changing market conditions. The key takeaway is that risk cannot be completely avoided, but it can be managed effectively through diversification. In essence, MPT provides a scientific approach to investing by demonstrating that it is not just about picking the best stocks, but about structuring a portfolio in a way that balances risk and return. By following these principles, investors can increase their chances of achieving consistent long-term growth while minimizing unnecessary risks. Chapter 8: Behavioral Finance. In the study of behavioral finance, the focus is on understanding how human psychology affects financial decisions and market behavior. Traditional economic theories assume that investors are rational, always making logical choices based on available information. However, in reality, people often let emotions, biases, and mental shortcuts influence their investment strategies, sometimes leading to poor decisions that can hurt their financial success. One of the most common biases is overconfidence. Many investors believe they have superior knowledge or predictive abilities, thinking they can consistently outperform the market. This confidence leads them to trade excessively, convinced that each trade is based on sound reasoning. However, research shows that frequent trading often results in lower overall returns. Every transaction comes with costs, including brokerage fees and taxes, which can add up over time and erode profits. Additionally, trying to predict short-term market movements is extremely difficult, even for professionals, and most individual investors do not have any real advantage over the broader market. Another widespread psychological trap is the tendency to see patterns where none exist, known as the clustering illusion. Investors often believe they can identify trends in stock prices, thinking that past movements can predict future ones. This leads them to buy stocks that have recently performed well, assuming they will continue to rise, and sell those that have declined, fearing further losses. In many cases, this results in the classic mistake of buying high and selling low, the opposite of what a successful investor should do. Stock prices tend to be unpredictable in the short term, and past performance does not guarantee future results. Loss aversion is another powerful emotional factor influencing investment behavior. People feel the pain of financial losses much more deeply than they feel joy from equivalent gains. Because of this, investors often refuse to sell losing stocks, holding on to them in the hope that they will recover. This reluctance can trap capital in unproductive investments instead of reallocating it to better opportunities. At the same time, investors might sell their winning stocks too quickly, locking in small gains instead of letting them grow over time. This behavior prevents them from maximizing their potential profits and achieving the best possible returns. Mental accounting is another way people make financial decisions that do not always align with their best interests. Investors tend to categorize their money based on its source or intended use rather than viewing it as part of a larger financial picture. For example, someone might treat a tax refund as extra money to spend rather than considering it as part of their overall wealth. Similarly, some investors may take bigger risks with a bonus or inheritance than they would with their regular salary, even though all money should ideally be managed with the same level of care. This compartmentalized thinking can lead to irrational choices and missed opportunities for growth. Herd behavior is another major factor affecting investment decisions. People often follow the crowd, assuming that if many others are investing in a particular stock or asset, it must be a good choice. This herd mentality can lead to speculative bubbles, where asset prices skyrocket as more and more investors jump in, fearing they will miss out on profits. However, when reality sets in and prices crash, many investors suffer significant losses. The rise and fall of technology stocks in the dot-com bubble and the housing market collapse of 2008 are examples of how herd behavior can lead to financial disasters. Understanding these psychological influences is crucial for making smarter investment decisions. Investors who recognize their biases can take steps to counteract them. One effective approach is to create a set of predefined rules for investing and stick to them regardless of emotions or market noise. For instance, maintaining a diversified portfolio helps spread risk across different asset types, reducing the impact of a single bad investment. Another important strategy is to focus on long-term goals rather than reacting to short-term market movements. By avoiding impulsive decisions and staying patient, investors increase their chances of building wealth over time. The study of behavioral finance reveals that markets are not always driven by logic and rationality. Instead, they are often influenced by emotions. Chapter 9: A Fitness Manual for Random Walkers. Starting early is one of the most powerful ways to build wealth. The earlier one begins saving and investing, the more time their money has to grow. This is because of compound interest, which allows earnings to generate additional earnings over time. Even small contributions made consistently can accumulate into a significant amount in the long run. Many people underestimate the impact of compound growth, but history has shown that those who start early and remain consistent often achieve greater financial success compared to those who delay investing. Understanding personal risk tolerance is just as important. Every individual has a different comfort level when it comes to taking financial risks. Some are comfortable investing in high-risk stocks with the potential for high returns, while others prefer safer investments like bonds or real estate. Recognizing one's risk tolerance is crucial in creating a portfolio that aligns with personal financial goals and emotional comfort. If an investor takes on too much risk, they may panic during market downturns and make irrational decisions. On the other hand, being too conservative might result in lower returns, making it harder to reach long-term financial goals. Diversification is another key principle. Placing all investments in a single stock or sector exposes an investor to unnecessary risk. Instead, spreading investments across various asset classes, such as stocks, bonds, commodities, and real estate, helps reduce overall risk. If one part of the portfolio underperforms, another part may perform well, balancing the impact. A well-diversified portfolio can provide more stable returns and protect investors from severe losses. A long-term perspective is crucial for successful investing. Market fluctuations are inevitable, and short-term price swings can be misleading. Many inexperienced investors panic when the market declines and sell their investments at a loss. However, historical data shows that markets tend to recover and grow over time. By staying invested and avoiding impulsive decisions based on temporary downturns, investors can benefit from long-term market growth. Patience and discipline are essential in this regard. Minimizing investment costs is another important aspect. Many financial products come with hidden fees and high transaction costs that can eat into returns. Actively managed mutual funds, for example, often charge high fees while failing to outperform the market consistently. In contrast, low-cost index funds provide broad market exposure with minimal fees, allowing investors to keep more of their earnings. Choosing cost-efficient investment options can significantly enhance overall returns. Rebalancing a portfolio periodically ensures that investments remain aligned with one's goals. Over time, certain investments may grow faster than others, shifting the original allocation. Without rebalancing, a portfolio may become too concentrated in one asset class, increasing risk exposure. By periodically adjusting the portfolio back to the intended allocation, investors can maintain a balanced strategy that reflects their risk tolerance and financial objectives. Tax efficiency should not be ignored when investing. Utilizing tax-advantaged accounts, such as retirement accounts, can lead to significant savings. These accounts offer tax deferrals or exemptions, which allow investments to grow without being reduced by annual taxes. Taking advantage of these options can accelerate wealth accumulation and provide a more efficient way to reach financial goals. Continuous education and staying informed about the market is essential for making sound financial decisions. While it is impossible to predict short-term market movements, understanding basic investment principles, economic trends, and financial products allows investors to make more informed choices. Keeping up with financial news, reading investment literature, and learning from past market trends can help individuals refine their strategies and stay confident in their investment approach. By following these principles, starting early, understanding risk tolerance, diversifying investments, maintaining a long-term perspective, minimizing costs, rebalancing regularly, optimizing tax efficiency, and continuously learning, investors can create a strong foundation for financial success. These strategies help build a disciplined approach to investing, ensuring that wealth grows steadily over time while avoiding common pitfalls that often hinder financial progress. Chapter 10. Handicapping the Financial Race. Investing requires a clear understanding of different financial instruments and how they work in the broader economic landscape. There are many ways to grow wealth, but each option comes with its own set of risks and rewards. One of the most common and widely used investment vehicles is equities or common stocks. When someone buys a stock, they essentially own a small portion of a company. Stocks have the potential to provide significant returns over time through capital appreciation, meaning their value increases, as well as through dividends, which are portions of a company's profits paid out to shareholders. However, stocks are also volatile. Their prices fluctuate based on a variety of factors, including company performance, industry trends, and overall market conditions. Because of this unpredictability, stocks can be rewarding but also come with a high degree of risk. For those looking for a more stable option, bonds serve as an alternative. Unlike stocks, bonds do not represent ownership in a company. Instead, they're debt instruments issued by governments or corporations. When an investor buys a bond, they are essentially lending money to the issuer in exchange for regular interest payments, also known as coupon payments, over a fixed period. At the end of this period, the bond matures, and the issuer repays the original amount borrowed. Bonds are generally considered to be safer than stocks because they provide steady income and are less susceptible to market fluctuations. However, The trade-off is that their returns tend to be lower compared to stocks, especially over the long term. Real estate investment trusts, REITs, offer another avenue for investors seeking exposure to the real estate market without the complexities of owning physical properties. A REIT is a company that owns, operates, or finances income-generating real estate properties, such as office buildings, shopping centers, and apartment complexes. These trusts allow investors to earn returns through dividends derived from rental income. Unlike owning real estate directly, investing in REITs provides liquidity, meaning shares can be easily bought and sold on stock exchanges. This makes REITs an attractive option for those looking to diversify their portfolio while still benefiting from the income potential of real estate investments. Commodities such as gold, oil, and agricultural products are another asset class that investors often consider. These tangible goods are typically traded on commodity markets and can serve as a hedge against inflation. For example, during times of economic uncertainty, gold tends to rise in value because investors see it as a store of wealth. However, commodities can be highly volatile due to factors like geopolitical events, natural disasters, and fluctuations in supply and demand. This unpredictability makes them a risky investment, best suited for those with a high tolerance for market swings. Mutual funds are a popular choice for individuals who want to invest in a diversified portfolio without having to pick individual stocks or bonds themselves. These funds pool money from multiple investors and are managed by professional fund managers who decide where to allocate the funds. Mutual funds can invest in stocks, bonds, or a combination of both, providing diversification that can help reduce risk. However, they often come with management fees, which can eat into returns over time. Exchange-traded funds, ETFs, function similarly to mutual funds but have a key difference. They're traded on stock exchanges like individual stocks. This allows for greater flexibility, lower fees, and real-time pricing, making them an appealing option for investors who want the benefits of a mutual fund without the associated costs. Understanding risk and return is fundamental to making sound investment decisions. Generally, higher returns come with higher risk. Stocks, for instance, have the potential for substantial gains but also significant losses. Bonds, while safer, provide lower returns. A well-balanced portfolio should align with an individual's financial goals, time horizon, and risk tolerance. The process of spreading investments across different asset classes, stocks, bonds, real estate, and commodities, is known as diversification. Diversification helps reduce risk by ensuring that losses in one area can be offset by gains in another. Chapter 11. Tailoring a portfolio to your needs. Building a successful investment portfolio requires careful planning to align with financial goals, time horizons, and risk tolerance. The key to long-term success is creating a balanced and personalized strategy that can withstand market fluctuations while growing steadily over time. The first step is to assess financial goals and risk tolerance. Every investor has different objectives. Some may be saving for retirement, others for a home or a child's education. The timeline for achieving these goals determines how aggressively one should invest. A young investor saving for retirement in 30 years can afford to take more risks than someone approaching retirement in the next 5 years. Risk tolerance also plays a crucial role. Some people can handle market ups and downs without stress, while others may panic and sell during downturns. It is important to be honest about one's ability to stay invested during volatile periods. After defining goals and risk tolerance, the focus shifts to asset allocation, which is how investments are divided among different asset classes like stocks, bonds, and real estate. The right mix depends on factors like age, income, and financial needs. Younger investors often invest heavily in stocks because they have time to recover from market downturns, whereas older investors may favor bonds for stability and income. A common rule of thumb is that an investor should subtract their age from 100 to determine the percentage of stocks in their portfolio, though this varies based on individual circumstances. Diversification is essential in reducing risk and increasing returns. By spreading investments across various sectors, industries, and even countries, investors can avoid overexposure to any single asset. For example, if an investor puts all their money in technology stocks and the sector crashes, their portfolio will suffer greatly. However, by holding a mix of stocks, bonds, and real estate investments, losses in one area can be offset by gains in another. Diversification also applies to company size, as investing in large, mid-sized, and small companies can help balance risk and reward. Once a portfolio is established, it requires regular monitoring and rebalancing. Over time, some investments will perform better than others, causing the portfolio's original allocation to shift. If stocks grow significantly, they may take up a larger percentage of the portfolio than intended, exposing the investor to more risk than they initially planned. In this case, selling some stocks and buying more bonds can restore the original balance. Rebalancing should be done periodically, such as once a year, to maintain the desired level of risk and return. Investment costs can significantly impact long-term gains. Fees from actively managed mutual funds and excessive trading can eat away at profits. Keeping expenses low is crucial, and one of the best ways to do this is by investing in low-cost index funds. These funds track the overall market and have lower fees compared to actively managed funds. Since research shows that most actively managed funds do not consistently outperform the market, index funds offer a more reliable way to build wealth over time. Tax efficiency is another important consideration. Different types of investment accounts offer tax advantages that can help maximize returns. Retirement accounts like 401(k)s and IRAs provide tax benefits, allowing investments to grow tax-free or tax-deferred. Investors should also be mindful of capital gains taxes when selling investments and consider strategies like tax loss harvesting, which involves selling losing investments to offset gains and reduce tax liability. Patience and discipline are crucial for successful investing. Markets are unpredictable, and emotional decisions can lead to costly mistakes. Many investors panic during market downturns and sell at a loss, only to miss out on the recovery. Sticking to a well-planned strategy, avoiding frequent trading, and ignoring short-term market noise helps in achieving long-term success. A well-tailored portfolio is not just about picking the right stocks or bonds. It's about creating a structured and sustainable investment plan that adapts to changing financial needs. By setting clear goals, diversifying investments, minimizing costs, managing taxes efficiently, and staying disciplined, investors can build wealth steadily and achieve financial security over time. Chapter 12: 3 Giant Steps Down Wall Street. The final section of A Random Walk Down Wall Street focuses on 3 essential steps that investors can take to secure financial success. These steps are not based on speculation, market timing, or trying to outsmart professional investors. Instead, they rely on simple, proven methods that have historically led to steady and reliable growth of wealth. The core message revolves around the importance of consistency, patience, and making smart investment choices that minimize unnecessary costs and risks. One of the most crucial steps emphasized is starting a savings plan as early as possible. Many people delay saving for retirement or other long-term goals because they assume they have plenty of time. However, the power of compound interest makes an enormous difference when saving begins early. Compounding allows money to grow exponentially because returns are reinvested, generating additional earnings over time. The earlier someone starts, the longer their investments have to grow. Even small amounts saved regularly can result in significant wealth over the decades. The key is consistency, making saving a habit rather than an afterthought. For instance, if a person starts saving in their early 20s and invests regularly, they will accumulate far more wealth than someone who begins saving in their 40s, even if the latter invests larger sums. This is because the money invested early has more time to compound. The difference between starting early and starting late can be dramatic, making early savings one of the most powerful financial decisions an individual can make. Beyond simply saving, it is important to invest wisely. Many investors make the mistake of picking individual stocks, trying to identify the next big winner. However, studies have shown that most professional fund managers fail to consistently outperform the market over long periods. If professionals with extensive resources and expertise struggle to beat the market, individual investors have an even smaller chance of doing so. Instead of engaging in stock picking, a better approach is to invest in low-cost, broad-based index funds. Index funds track the performance of a specific market index, such as the S&P 500, which represents a collection of the largest companies in the United States. By investing in an index fund, an investor effectively owns a small piece of every company in that index. This approach has several advantages. First, it provides diversification, reducing the risk associated with holding individual stocks. If one company performs poorly, it is balanced by the others in the index. Second, index funds have significantly lower fees compared to actively managed funds. Actively managed funds charge high fees for professional management, but since they rarely outperform the market, investors end up paying more for subpar results. By choosing low-cost index funds, investors can keep more of their returns, allowing their money to grow faster over time. Once an investor has committed to investing in index funds, the next important step is maintaining discipline and sticking to the plan. Many investors are tempted to time the market, buying stocks when prices are low and selling when prices are high. While this sounds like a logical strategy, in practice, it is nearly impossible to execute consistently. Market movements are unpredictable, and even seasoned investors struggle to determine the best times to buy and sell. Studies have shown that investors who try to time the market often miss the best performing days, significantly reducing their overall returns. The best approach is to stay invested through all market conditions and continue contributing regularly, regardless of short-term fluctuations. Market downturns can be particularly challenging for investors. When stock prices decline, fear and panic often lead people to sell their investments to avoid further losses. However, history has shown that markets recover over time. Investors who remain patient and continue investing during downturns benefit from buying shares at lower prices, which ultimately leads to greater returns when the market rebounds. Selling during downturns locks in losses and prevents investors from benefiting from future growth. The key to success is maintaining a long-term perspective and resisting emotional decision-making. Another important aspect of maintaining discipline is rebalancing the portfolio periodically. Over time, some investments will grow faster than others, causing the portfolio to drift from its original asset allocation. For example, if stocks perform well for several years, they may take up a larger portion of the portfolio than initially intended. Rebalancing involves selling some of the overperforming assets and buying underperforming ones to restore the original balance. This ensures that the portfolio remains aligned with the investor's risk tolerance and long-term goals. A well-balanced portfolio should also include a mix of asset classes, such as stocks and bonds. Stocks offer higher potential returns but come with greater risk, while bonds provide stability and consistent income. The right mix depends on an investor's time horizon and risk tolerance. Younger investors can afford to take more risk by holding a higher percentage of stocks since they have time to recover from market downturns. As investors approach retirement, shifting to a more conservative portfolio with a higher percentage of bonds can help preserve capital and reduce volatility. Throughout the journey of investing, avoiding unnecessary costs is critical. Many investors lose a significant portion of their returns to fees, commissions, and taxes. Actively managed funds charge high management fees, which eat into returns over time. Frequent trading also generates transaction costs and potential tax liabilities. Keeping investment costs low by choosing low-cost index funds and minimizing trading activity ensures that more money stays invested and grows over time. Another common mistake investors make is chasing past performance. It is easy to be attracted to funds or stocks that have recently performed well, assuming they will continue to do so in the future. However, historical data shows that past performance is not a reliable indicator of future results. By the time an investment has gained widespread attention, much of its potential upside may have already been realized. Instead of chasing trends, investors should stick to their diversified portfolio and avoid making decisions based on short-term performance. Dollar cost averaging is another effective strategy that reinforces discipline and reduces the impact of market volatility. This approach involves investing a fixed amount of money at regular intervals, regardless of market conditions. By consistently buying shares over time, investors purchase more shares when prices are low and fewer shares when prices are high. This reduces the risk of making large investments at the wrong time and helps smooth out market fluctuations. Tax efficiency is another important consideration for long-term investors. Holding investments in tax-advantaged accounts, such as 401(k), S or IRAs, allows money to grow tax-free or tax-deferred, maximizing long-term returns. Investors should also be mindful of capital gains taxes and aim to hold investments for the long term to benefit from lower tax rates on long-term gains. In summary, financial success is achievable by following a straightforward and time-tested approach. Starting early with consistent savings, investing in low-cost index funds, and maintaining a disciplined, long-term investment strategy are the three essential steps that lead to wealth accumulation. Avoiding market timing, minimizing costs, diversifying investments, rebalancing periodically, and using tax-efficient strategies further enhance the likelihood of success. While investing may seem complex, sticking to these simple principles can provide financial security and long-term growth for anyone willing to follow them.